Hi and welcome to Market Vision's Short Takes. I'm Deepak Shenoy and today we'll talk about the what, how and why of the PE ratio, a term often mentioned in stock market discussions. So the definition or the what is price to earnings ratio is what PE means. Now price here is the market price of the share of a company and earnings are the net profit on a per share basis. So you take the net profit divided by the total number of shares. You have two kinds of PE. There's a trailing PE, which is take the last 12 months earnings and use that to determine the PE. You typically see companies reporting their earnings once a quarter, and each earnings report contains the earnings per share of that company for that quarter. So if you take last 4 quarters, you get the trailing 12 month of the TTM earnings per share. You can use that to calculate the trailing PE. Or you can use the forward PE, which is basically analyst estimates of the next 12 months in terms of earnings per share. So that is the forward EPS. You use the forward EPS to calculate the forward price to earnings ratio. Now how do you get to this figure? You can use online information sites like Economic Times, Money Control and so on. Of all the sites that are out there, I've found that Economic Times seems to have the most accurate data. A lot of times there is data valid, but it is outdated. Sometimes they will at this point show you something like the trailing 12 months as of March. Now we're in December, so as of March is like 7 months ago. There have been 2 quarter reports after that. They haven't taken into consideration that and so on. So you got to ensure that they have the latest quarter and so on. If you want to go down to the metal, you can actually go into the stock exchange websites, look at the financials of any individual company, take the last 4 quarters earnings per share announced and add them up. For forward PE, now all this gives you the trailing PE. The forward PE is, there is really no simple data source. Most estimates are made by individual analysts and they are not big enough in terms of numbers that can actually create a good consensus estimate. So if you have only about 2 or 3 analysts covering a stock and they give you wide ranging estimates of profits, you can't really use that to make something that's reliable as a forward PE indicator. In the US you have 30, 40, 100 analysts covering a stock, so you can take a consensus estimate. In India, often estimates are wrong. That's also because companies are not required to reveal a lot of information, so you can't make a reasonably educated guess. Therefore, forward PE figures are not very easily available. Trailing PEs are. Now, why would you ever need a PE ratio? PE is just a valuation metric. It's a way to value a company. So if you have two shares, one of which is 100 rupees and another which is 500 rupees, you really don't know if the 500 rupee one is expensive or is it cheaper in comparison to the 100 and so on. So when you take two companies that live in the same sector, so for instance DLF and Unitech, you might find that using PEs, Unitech and the sub 100 levels may actually turn out to be cheaper than DLF at the sub 300 levels. The difference is largely in the fact that certain companies operate in different environments, but in the same sector you would typically expect a similar multiple to be given to two companies in the same sector if they're of the same size and so on. So you can compare PEs of two companies which are in the same sector, but you wouldn't compare across sectors. So for instance, you wouldn't compare a steel company with an IT company like Infosys. But within the steel sector you could compare two companies and so on. So let's look at what PE ranges and what they mean to us. When you look at PEs of greater than 20, you're typically talking companies where you expect a very high amount of growth, and or a company that has a serious technological or competitive advantage that doesn't allow other companies to come in. So this company can literally monopolize the sector and get the best profits. It could also mean that the valuations are rich. That means this company could be overvalued. People may be expecting a lot out of it, and the company may not be able to meet those expectations. You see that quite often. When you have a P ranging between 12 and 20, typically this is more or less fair value because companies are expected to grow around this rate, and it's seen a lot in stable industries or industries that were growing very fast recently, but they've kind of grown to a size where they can't grow at a crazy pace, but they also have a lot of potential, like auto ancillaries and so on. Now, less than 12, typically low margin or commodity companies where you see that input prices can have a dramatic impact on profits. So you don't want to pay a huge price to earnings multiple. Effectively, PE is the number of times earnings that you would pay for a stock. So if a stock makes 10 rupees a year and the market price is 100, the PE is 10. You expect that in 10 years, countering inflation and so on, or maybe 20-30 years, the 10 rupees will grow to 100. So you even if the market price doesn't grow, the PE goes to 1, you'll still make back your money, or and so on. So the the idea here is that for low growth companies, low growth expectations, you would have low PEs. When you have low PEs, you may also have low expectations, and that may not be necessarily valid. So you find undervalued companies in the low PE ranges as well. So that's it about PE. We're coming up with new short takes on why is the PE important and what are the various ways to look at PE. But we'd love to hear your comments on this video. Visit our forums, connect with us, talk to us at marketvision.in, and thanks for listening.